Hey, good morning. Welcome back to the Junius Maltby channel, where we have bad sound, boring content, but sometimes good information and news headlines. Welcome back. Gold broke 1200 the other day, just briefly. That was surprising. I don't typically, like I've told you in the past, follow it closely all the time because I just don't care. Other than when I'm reporting the headlines to you guys and kind of letting you know where the numbers are at. And there's plenty of information on why I treat the gold price that way in past videos. So it was surprising to see 1200 up on the board, and then it retreated slightly from there, and we're sitting right now at about 1194, depending what site you're on when it's been updated, and so on. 1195, 1196.40 this morning. But it is, it's right there, right under 1200. Definitely higher than where some of the skeptics and naysayers predicted it would be at this point, at this time. So it's just very hard to predict, and you never know who to trust and who's going to predict what accurately. We saw that with the most recent presidential election. Sometimes the, quote, experts don't get everything 100% right, let alone 50% right. Weathermen used to get a bad rap, but I have found most recently that weathermen are the most accurate prognosticators and predictors that there are. They've been pretty spot on this year so far. Today we're not going to meander too much. Hopefully we can stay on point and on topic, because we're going to be focused, kind of zeroed in on one particular piece of paper, one particular article. Every year this comes out. It's the World Gold Council Outlook for the year we're going into. So right now we have the World Gold Council Outlook 2017 Global Economic Trends and their impact on gold. This is a multi-page PDF, pretty big file page. Or you can go online, you can find this, you can Google it. You can print the whole thing off or read it right there on your screen. I took a lot of highlights, probably 70 or 60% of the content of this release, this paper, and it's going to be here on the video. We're going to read through most of it. Might skip some sections just because we don't want to dial up the boredom too much and put anyone to sleep. However, I have received messages. There are a few of you out there that are part of this community. This does kind of creep me out a little bit, that like to listen to this channel when they're going to sleep. So go ahead and cancel your Ambien prescription and dial into the Junius Maltby channel. Here we go. Heightened political and geopolitical risks. Political risk is rising. Europe will hold key elections in the Netherlands, France, and Germany in 2017. As John Nugi says, the election cycle will happen against a backdrop of continued citizen unrest, fueled by the ongoing uneven distribution of economic welfare. In addition, Britain must negotiate its exit from the European Union. While the UK economy is still expanding, the pound fell sharply following the referendum decision and continues to weaken every time the markets sense that there is an increased chance of a hard Brexit. In the US, there are positive expectations about some of the economic proposals of President-elect Donald Trump and his team, but there are also concerns. The US dollar has gained ground since Trump swept to victory last November, but uncertainty is rife. Jim O'Sullivan sees a meaningful risk that negotiations on trade will turn belligerent and suggests that confidence in markets could be affected by geopolitical tensions triggered by the new administration. Confidence could be affected by geopolitical tensions triggered by the new U.S. administration. That's from Jim O'Sullivan, Chief U.S. Economist, High Frequency Economics. Major trends in 2017. The gold price had a strong performance in 2016, rising close to 10% in U.S. dollar terms, higher in most other currencies, and amassing multi-year record inflows through physically backed gold ETFs, making it one of the best performing assets last year, despite a post-U.S. election pullback, and the price has gained more than 5% since the Federal Reserve increased rates in mid-December. But what does 2017 hold for the gold market? Using the economic perspective from our guest economists as a backdrop, we believe there are 6 major trends in the global economy that will support gold demand and influence its performance this year. Number 1, heightened political and geopolitical risks. Number 2, currency depreciation. Number 3, rising inflation expectations. Number 4, inflated stock market valuations. Number 5, long-term Asian growth. Number 6, opening of new markets. Policy divergence is likely to lead to downward pressure on the euro and pound. John Nugent, former Reserves Chief Manager, Bank of England. Currency depreciation. Monetary policy is likely to diverge between the U.S. and other parts of the world. The Fed is widely expected to tighten monetary policy, but it is far from certain that other central banks may be willing and or able to do so. The situation in Europe is a case in point. As John Nugent states, Europe's economies are likely to face a continuation of the current tight fiscal expansionary monetary policy as they have for at least the last 5 years. Since the European Central Bank announced further quantitative easing measures in January 2015, its balance sheet has increased by approximately 1.5 trillion euro, resulting in an increase of 70% and bringing the current balance sheet total to more than 3.6 trillion euro. This will inevitably lead to fears of currency depreciation. In fact, over the past century, gold has vastly outperformed all major currencies as a means of exchange. One of the reasons for this is that the available supply of gold changes little over time, growing only 2% per year through mine production. In contrast, fiat money can be printed in unlimited quantities to support monetary policies. This difference between gold and fiat currencies can drive gold investment demand as investors seek to preserve capital from depreciating currencies, exemplified by European investors last year when they turned to gold through bars, coins, and ETFs. German investors added 76.8 tons of gold, that's an increase of 76%, to ETFs in 2016. They also bought 72.3 tons through bars and coins between Q1 and Q3 2016, based on available data. But gold's relative steadfastness can also support central bank demand. To that end, central banks continue to acquire gold as a means of diversifying their foreign reserves, and we expect them to continue to do so in 2017. Here's a great chart. All major currencies have depreciated over the past century relative to gold. You can see it right there, US dollar, the mark, the Reichsmark, Deutschmark. It's very clear, portraying that all major currencies depreciate against gold and have done so and will continue to do so. Several key historical moments can be noted here on the chart. This is my input and interjection. You can see reflected in this chart here the 1933 revaluation of gold in the United States, the Bretton Woods Agreement where it was revalued again. So we saw it go from $20.67 to $35 an ounce to $42 an ounce. And then you can see 1971, Nixon closing the gold window, as you can see on this chart. But you can definitely see the currencies revalued against gold by executive determination, by government fiat. There you go. Exchange rates have historically been the key channel through which Asian economies have adjusted to higher U.S. interest rates. Rising inflation expectations. Nominal interest rates are widely expected to increase in the U.S. this year, but all the economists we spoke to forecast that inflation will rise as well. An upward inflationary trend is likely to support demand for gold for 3 reasons. First, gold is historically seen as an inflation hedge. Second, higher inflation will keep real interest rates low, which in turn makes gold more attractive. Third, inflation makes bonds and other fixed income assets less appealing to long-term investors. Inflated stock market valuations. Stock markets had a significant rebound in the last stretch of 2016, and while some stock markets are just recovering from lackluster multi-year performance, stocks in the U.S. have reached historic highs. In many cases, valuations have been elevated as investors increase their risk exposure in search of returns in a very low yield environment. Until now, investors have used bonds to protect their capital in the event of a stock market correction. As rates rise, this is a less viable option. and in the meantime, the risk of a correction may be increasing. The interconnectedness of global financial markets has resulted in a higher frequency and larger magnitude of systemic risks. And as Jim O'Sullivan puts it, the U.S. economic expansion will not last forever. In such an environment, gold's role as a portfolio diversifier and tail risk hedge is particularly relevant. Inflation momentum remains upward. Jim O'Sullivan, Chief U.S. Economist, High Frequency Economics. Portfolio resilience and diversification in the face of shocks will be key. John Nugent, former Reserves Chief Manager, Bank of England. Long-term Asian growth. Macroeconomic trends in Asia will support economic growth over the coming years, and in our view, this will drive gold demand. In Asian economies, gold demand is generally closely correlated to increasing wealth. And as Asian countries have become richer, their demand for gold has increased. The combined share of world gold demand for India and China grew from 25% in the early 1990s to more than 50% by 2016. And other markets, such as Vietnam, Thailand, and South Korea, have vibrant gold markets also. Asia will account for around 60% of global growth in 2017. David Mann, Chief Economist, Asia, Standard Chartered Bank. Opening of new markets. Gold is becoming more mainstream. Gold-backed ETFs made gold accessible to millions of investors, primarily in the West, over the past decade, but other markets continue to expand too. China has seen dramatic growth in recent years through gold accumulation plans, physically settled gold contracts in the Shanghai Gold Exchange. In Japan, pension funds have increased their gold holdings over the past few years in the corporate sector. More than 200 defined benefit pension funds have invested in gold. In addition, more than 160 defined contribution plans have added gold to their list of investments. We expect this trend to continue and expand into Western markets, where pension funds have had to rethink asset allocation strategies following prolonged exposure to low and even negative interest rates. In our view, this will result in structurally higher demand. Innovation is evident across all markets, but at the end of last year, one development stood out. The Accounting and Auditing Organization of Islamic Financial Institutions, the AAOIFI, with support from the World Gold Council, launched the Sharia standard for gold, opening up the Muslim world to gold investment. Mark Mobius of Franklin Templeton thinks that the new Sharia standard on gold will be a game changer. Whereas previous Sharia rulings were fragmented or non-existent, the standard provides definitive guidance on gold products, potentially allowing millions of Muslims to invest in gold. Furthermore, Islamic finance has expanded rapidly in recent years, with many countries actively promoting this sector as part of their economic development and diversification policies. These factors can potentially propel gold demand across many Muslim markets, from Malaysia, the UAE, and Saudi Arabia, where Islamic finance is well established, to countries such as Indonesia and Pakistan, which are pushing for Islamic finance to play a greater role in their economic infrastructure. With the size of Sharia-compliant AUM expected to grow to US $6.5 trillion by 2020, according to the Islamic Finance Stability Board, just a 1% allocation to gold would equate to nearly 65 billion US dollars, or 1,700 tons in new demand. The Sharia gold standard will enable the foundation of what could be the most significant event for Sharia finance in modern times. Dr. Mark Mobius, Executive Chairman, Templeton Emerging Markets Group. U.S. Brace for more Fed tightening. Dubbed the most accurate forecaster in America over the past 10 years by MarketWatch, Jim O'Sullivan sets out his views for 2017 and beyond. He suggests U.S. economic growth will pick up pace. The Federal Reserve will tighten rates by at least 175 basis points over the next 2 years, and inflationary pressure will mount. He also fears an economic downturn is highly likely at some stage during the Trump presidency. For more on these predictions, you can also find this document that we are discussing online. I'll include a link down below in the description for you as well. Europe, a year of political uncertainty. John Nugent, renowned economic and geopolitical commentator, expects 3 trends are likely to dominate Europe in 2017. A continuation of tight fiscal and loose monetary policy, an increase in unconventional economic interventions, and growing divergence with U.S. monetary policy. These are likely to put further pressure on the euro and create rising friction between northern and southern members of the eurozone. For investors, this suggests a further year of volatility and surprises as economic concerns continue to be overshadowed by political ones and deeply held beliefs and long-established systems are challenged. Trends to watch. 3 trends can be foreseen in Europe. First, while Europe's politicians will be wary of increasing austerity at this stage of the electoral cycle, and there is ongoing talk of the need for infrastructure spending, the harsh realities of German insistence on fiscal orthodoxy will not entirely give way. Europe's economies are therefore likely to face a continuation of the current tight fiscal expansionary monetary policy as they have for at least the last 5 years. Second, unconventional economic policies are likely to become more common as establishment politicians become increasingly populist. One example of this is the increasing willingness to use unorthodox taxation policies such as fines on unpopular companies and sectors. The financial and energy sectors have long been the subject of large fines, and they are being followed by the automotive and pharmaceutical industries. And lastly, we are likely to see increasing policy divergence with the U.S. as the policy mix changes to a combination of looser fiscal, tighter monetary stance. The combination of looser fiscal policy and higher official rates in the U.S. and a continuation of tight budgets and loose monetary policy in Europe is a significant change from recent years, when policy in both regions has been similar. The divergence is likely to lead, at least initially, to downward pressure on the euro and the pound. For Europe, a weaker euro will fuel trade surpluses in northern countries such as Germany and put further strain on relationships between them and the rest of the eurozone. Faced with this mixture of political risk and policy divergence, many investors may be tempted to put their portfolios into defensive mode. But with cash continuing to yield little if any return, and markets that respond to events in counterintuitive ways, this would be unwise. Instead, portfolio resilience and diversification in the face of shocks will be key. Asia, a standout region with domestically sourced growth. David Mann, a prize-winning economist, believes that Asia will account for around 60% of global growth this year, cementing its economic independence from the West. Growth in China is likely to remain at current levels for most of the year. India may suffer following the demonetization policy. Overall, the entire region is likely to see some exchange rate weakness as U.S. interest rates tighten and its economy reflates. Lots of information to ponder, lots of data to contemplate, but overall I think it paints a pretty good picture for gold. And as usual, I think gold has a lot going for it. Gold has a lot of strength going into the years to come, so keep stacking, feel good about it, and I'll see you on the next one. Thanks for tuning into the Junius Maltby channel.